Hey everyone, and welcome. Today, we're going to talk about something that's, well, kind of like an invisible force shaping our entire financial world: interest rates. You hear about them all the time, but what are they, really? Let's dive in and make sense of it all. You ever wonder about that? How can a few people in a meeting somewhere make a decision that directly changes your car payment or messes with your retirement plan? It feels disconnected. But trust me, it's not. And today, we're going to connect all those dots for you. At its absolute core, it is this simple. An interest rate is just the price you pay to borrow money. And on the flip side, if you're the one lending the money, like when you put cash in a savings account, it's the reward you get. It is quite literally the price of money. Okay, I want you to hold on to this idea because it's going to be our guide through this whole explainer. Think about it. When gravity is low, you feel light, you can jump higher. When gravity is cranked up, every single move takes more effort. We're about to see how this financial gravity pulls on everything from what you pay for a house to the entire stock market. So, who's in charge of the gravity dial? Well, here in the US, that job belongs to the Federal Reserve. You've probably heard them called the Fed. You can think of them as the gatekeepers of the nation's entire money supply. Now, the Fed doesn't pick up the phone and tell your local bank what interest rate to put on your car loan. That's not how it works. What they do is set this one super important base rate. It's the rate banks charge each other for overnight loans. And since that's the starting cost for banks to get their hands on money, it just ripples out and affects pretty much every other loan out there. And that brings us right to that ripple effect. Let's trace exactly how a decision made by the Fed actually finds its way into your bank account. You know, it's a really straightforward chain reaction. Step 1, the Fed makes its move. Step 2, that makes money more expensive for the big banks. And step 3, well, banks aren't going to just eat that cost. They pass it right along to us. And what does that mean for you in the real world? It means that financial gravity just got a whole lot stronger. The monthly payment on a new mortgage, it goes up. The interest you're paying on your credit card debt suddenly feels way heavier. And for businesses, borrowing money to build a new warehouse or hire more people, yeah, that just became a much tougher decision. And here's the kicker. That's the whole point. Believe it or not, this is all on purpose. When the economy is running a little too hot and prices are going up and up, inflation, the Fed intentionally raises rates to pump the brakes. They want to make spending less attractive and saving more attractive to get things to cool down. Okay, so we've got how it affects your loans, but what about your investments? Let's switch gears and talk about the stock market. Now, the story you usually hear on the news is pretty simple. And the logic here makes a lot of sense. First off, just like it costs you more to borrow, it costs companies more to borrow too. That can really eat into their profits. But second, and this is a big one, why would you risk your money in the stock market, hoping for an 8% return when suddenly you can get a nearly guaranteed 5% from a super safe government bond? A lot of money just naturally flows from the risky bucket to the safe bucket. All right, stick with me here because this gets a little more into the weeds, but it's absolutely crucial for understanding why stock prices move. So imagine a company is expected to earn $1 billion 5 years from now. Well, with high interest rates, you could take less money today, put it in something safe, and earn a ton of interest over those 5 years. So that promise of $1 billion way off in the future becomes less valuable to you right now. This is what the pros call a discount rate, and it acts just like that gravity we talked about, pulling down the value of all those future earnings. And boom, the stock price comes down with it. So, higher rates mean lower stock prices. Simple enough. Case closed, right? Well, not so fast. Like with pretty much everything in economics, the simple story isn't always the whole story. Right? I mean, if it were that easy, we'd all be rich. Just sell everything the second you hear the Fed might raise rates. But if you look in the data, that's not what happens. In fact, stocks have often done surprisingly well when rates are going up. So there's got to be another piece to this puzzle. And here it is. This is the key. We've been so focused on the what that rates went up. But what the market really cares about is the why. The reason behind the rate hike changes everything. Think about it. There are two totally different flavors of rate hikes. On one hand, the Fed might be raising rates because the economy is just on fire. Everybody's got jobs, people are spending, companies are making record profits. The rate hike here is just a little tap on the brakes to keep things from getting out of control. That's a good why. But on the other hand, they could be raising rates because inflation is just raging. This is more of an emergency brake, a move designed to slow everything down on purpose. And that is a bad why for companies. And this isn't just some theory I'm throwing at you. There's some really cool research that backs this up.
Now, I know this chart looks complicated, but the story it tells is actually really simple. These lines just show what happens after two different kinds of rate hikes. One is a policy shock. That's the bad kind, fighting inflation, and you can see the economy shrinks. The other is an information shock, the good kind, signaling a strong economy. And look, economic activity actually goes up. It proves that the exact same action can have the completely opposite effect, all depending on the why.
And this brings us right back to that historical puzzle. The reason stocks often do well when rates are rising is because, for much of history, those rate hikes have been the good why. They were happening because the economy was so robust that companies were making more than enough extra profit to cover those higher borrowing costs.
So this is the big takeaway. The next time the headlines are flashing that rates are on the move and all the experts are talking, you now have a brand new way to look at it.
Ask yourself, is this a reaction to a booming economy, or is this an emergency measure to stamp out inflation? The answer to that question is going to tell you way more about what's coming next than the headline itself. See, it's the difference between just reacting to all the noise out there and actually hearing the signal. And by learning to ask why, you're not just a passenger anymore feeling the pull of economic gravity, you're starting to understand the forces that are actually moving our world. Thanks so much for watching.